Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the things you get jaded on in this business is beauty lists. The beauty lists come out and there's usually an angle, and I'll be honest, it usually has to do with raising revenue. And what was great about this weekend's Barron's, I'm sitting there, I got the mimosa going, the Chang mimosa, and I'm opening it up.
That's how we roll.
Ellen Zentner's getting a splash from Morgan Stanley, but they did their 100 women in finance, and it was actually adult, like they had no ringers. It was a power list. And so I'm looking around for strategists, and lo and behold, there's Lori Calvasina, who we welcome now with our RBC. How did you stumble upon that list? What did they see in your work? Did they actually read your reports?
I hope so. I hope so. No, to be honest, I have no idea who nominated me, but we're grateful for the honor. And Tom, it's interesting. I've been doing this a long time, and I had a birthday yesterday. I'm not going to tell you how old I am, but
29, looking solid.
29 over and over again. But I'll tell you, I spent a lot of time early on in my career trying to do the job the way people told me it needed to be done, and to tell stories and have conviction and all these other things. And at some point I figured out that was not what worked for me, and I'm going to do the job the way it makes sense to me and the way I know how to do it. And I've been much happier since I made that conversion. So maybe whoever nominated me for this list, wasn't looking at the young Lori, but is looking at the old Lori.
And your conviction is to pull back your Standard & Poor's call. Let's go through the process of that. Why did you cut your estimate?
So, we've been running, sort of a base case and a bear case since November. We thought it was going to be a highly unpredictable year. And I'll tell you honestly, Tom, what happened last week was my economics team updated their forecasts along with our rate strategist. And they made some big changes to the GDP and inflation views. And as I was reading their report, I said, I think there's a lot of, we don't have to agree, by the way. We can all do whatever we want to do. But I thought that sort of the impact they showed to 1Q GDP and how that reverberated to the year. So they kind of had, kind of a flattish quarter over quarter number in 1Q. And then they took their annual number from 2 down to 1.6. They made inflation stickier. They had yields moving down before moving back up at the end of the year. And I said, look, there's so much uncertainty out there right now. I'm not going to wait for this big moment of profound clarity. There are some things we can start to bake into our models now. So we flowed that through to the earnings, to the valuation model. Some other some other models, frankly, that were done on 12-month back test, I changed those to 9-month forward back tests, and the numbers changed a little bit. So we felt like it was time to put that out.
Primarily an earnings-driven adjustment, a discount rate adjustment, or just, I'm going to use the word I've heard on all the conference calls and all the, it's just uncertainty out there.
I think the idea of uncertainty taking a toll on the economy is what really showed up in the GDP forecast. And the GDP numbers flow through to my earnings model. So we pulled that from 271 down to 264. And also we have a GDP test in the targeting process. And we had actually said at the beginning of the year, where GDP ends up matters a great deal to this market. 2 to 3% GDP, historically a very strong range for the stock market. You're up about 10% on average. But if you look at a 1 to 2% number, and so remember Frances and her team went down to 1.6, so they're squarely in the middle of that range. That is typically an onerous environment for the stock market. We're down more often than up, and your average decline is about 3%. So moving from that 2 to 3 assumption to that 1 to 2 assumption was huge in the targeting.
I would editorialize, Paul, here that the tag team wrestling of Lori Calvasina and Frances Donald is to die for. Frances Donald is so damn good at GDP makeup that, frankly, Mr. Carney could call upon her for Frances Donald's candidate. I mean, Frances Donald can't be 100 finance women in America, right?
Well, she's Canadian.
It'd be on
it's a U.S. list.
Something like that. But trust me, if she was, she would have joined Lori on the list.
And Tom, the good thing about this list, many of the people on this list are regulars on Bloomberg Surveillance. So we're making the right calls there, it seems like.
We're trying every day.
Trying.
It's like a real list. What can I say?
I know.
It's not like a bunch of ringers.
It's good stuff. Lori, so where do we go from here? One could argue if the uncertainty is caused in part by the rhetoric associated with tariffs and changes in immigration policy and so on and so forth, I don't think that's going away anytime soon. So does that suggest that there's going to be a weight to this market for a while?
So look, I was talking to someone about this morning, and I got up early this morning. So I've had a bunch of conversations, but it feels like we're stuck in a moment we need to get out of. Yep. And I don't know if we're going to be able to get stuck out of that moment or not. But the longer we are stuck in this moment where it's just tariff, and uncertainty, right, the bigger toll that is going to take. I do think, as I've looked through a lot of the soft data, we're consistently seeing softness on CapEx expectations and employment expectations, and they're not terrible yet, so you could shift them back in the other direction. Right. But we are seeing evidence that this is having an impact. A
lengthy conversation, a value add for Global Wall Street. Lori Calvasina, Royal Bank of Canada, RBC, is with us right now in studio. We welcome all of you on your commutes across North America this morning. Good morning worldwide on Apple CarPlay, Android Auto, on YouTube, growing each and every day. Subscribe. Lisa Mateo demands that you subscribe to Bloomberg Podcasts out on YouTube, growing each and every day. So if I have a more tepid economy, I'm seeing a distribution of where SPX is down, whatever, but the median or average stock, including the Lori Calvasina worlds, getting hammered as well. So if I say I want to buy quality, how does Lori Calvasina, I want to own or buy quality. How does Lori Calvasina define that?
I think quality is going to be done on a sector-by-sector basis within industries. If I look at the Russell 2000 right now, it's actually been acting a little bit better than I would have anticipated. That's something that's calming me down. But if you look at it within the factors within the Russell 2000, it is the higher quality factors that are starting to act a little bit better. You look at things like positive, negative earnings. You can look at analyst ratings,
cash flows?
ROE. I tend not to do a lot of work on cash flows.
Because of CapEx variability.
Well, I mean, my clients do look at cash flows. I think that's a big part, especially of SMID investing. I'll tell you, it's a nightmare from a quantitative database perspective, so I don't tend to do a lot around it.
So where do we go from here? Do we think about just, we had a person here just a couple of guests ago, a couple of segments ago, who's now in the hedge fund going to 30 to 40% cash. Is that what you're hearing from some of your clients these days?
So I have heard a little bit of that. I will tell you the conversation last week, and I was a little bit more in sort of the hedge fund derivatives world last week, and there was more of a sense of looking to buy the dip.
Okay.
And sort of not entire clarity as 10% is actually the bottom, or maybe we have a bit more to go. But there was sort of a constructive bias, and I think you see that reflected in some of the options markets indicators, right? The VIX has moved up to certain extremes we saw late last year, but things like the SDEX and the TDEX haven't really moved, so indicating concern, right? But lack of kind of true fear at this point.
What does multiples do? I mean, if a multiple's a ratio, and I got market cap, price, whatever, in the denominator, I got the Calvasina statistic. Do we get multiple compression where we enjoy a selected bear market?
You get multiple compression if you look at like a median S&P 500 PE, you run that against the economic policy uncertainty index. You tend to get PE compression when the policy uncertainty moves up.
So then where do you hide?
So we've been telling...
Besides Sweeney's 30% cash.
So I'll tell you, Tom, the sectors are a struggle right now. And interestingly, I think every sector except tech and discretionary is outperforming in the S&P 500 this year. So that's one bit of the strategy job that, that's been a bit easier for folks. But I don't love defensives in here. So we're underweight staples. We're neutral healthcare. We think there's policy risk on both of those. There's cheap. And there's knee-jerk defensivism,
so
kind of going in.
So where's the optimism? What are you long on?
I've been telling people to buy financials, and I know they're cyclical, and I know they get hammered when sentiment gets hammered. And so, we're not sitting here saying they're not going to underperform a bit more if we, have to get to a bottom in sentiment. But the UMich Consumer Sentiment Survey is getting so bad, it is actually close to recession-like levels right now. And if you go back to our financial conference a few weeks ago, the banks sounded pretty calm and confident. I think they're going to be able to manage through this pretty well. I think they sort of proved themselves post SVB. So I think we're going through a sentiment shock that's going to have some reverberations unless we have a really nasty recession. I think the banks are okay, and I think honestly the sector was a little frothy before this all got started, and we've pulled that valuation froth out.
I know you did take down your S&P 500 earnings estimate. Do you think there's even more risk to earnings?
Yeah, and look, we took our number down a bit. I think we went to 264, and I apologize. First day new forecast. Sometimes, I get the numbers a little jumbled up. But, we took it down from 271 to 264, and we got there through updating the econ forecast. GDP take a huge bite out of that. Okay. The stickier inflation adds some back to the revenue line. But frankly, we also took our margin assumption down. I've been baking in some modest expansion this year. I just took it to flat. That's a guess, that's an assumption, but I've gone through so many earnings calls where, maybe there's one company that's, baked in a little bit of the China tariffs, but nothing on Mexico or Canada. And even some of the others have a lot of both and a lot of Mexico, and they haven't put any in. Mm-hmm. So we've got to go through the process of getting something in those numbers. Okay. I think it shows up in my number through Francis's GDP forecasts. But there's a lot of variability around it.
I strongly agree with that, whether nominal or real GDP. But what I find fascinating is the solution to this uncertainty for animals like you is you just bring in your x-axis. I mean, what's your new 3-year forecast? 4 months?
I actually never have a 3-year forecast. I mean, I always tell people,
you're so young. I get it.
I'm not. Unfortunately, I'm not anymore.
We used to have like a 3-year forecast.
Well, look, and look, I think that the strategy community has undergone a bit of a shift. When I started in the business, I think it was reasonable to have a 12-year forecast that you didn't have to change, or a 12-month forecast you didn't have to change all that much. Things move too quickly now, and I've sort of tried to get the conversation started about, like, stop writing these shame on you articles in December about the strategists who moved their targets around a couple times. That worked if you were Byron Wien. That doesn't work in this day and age anymore.
And may we honor Byron Wien. He was such a support. But Lori, I mean, are you out the 4th of July with a Sweeney view?
Look, we will revise as we need to revise, and as we get, new information that comes in. And we're very forthcoming about that in our product. Nothing is set in stone here.
Right.
What are your clients? What's the feeling you're getting from your clients, and how has it changed over the last 4, 5, 6 weeks? Because we kind of came into this administration saying animal spirits going wild. Yeah.
American exceptionalism.
Exactly right. And it was a real thing back in the day. But we are 180 degrees from that now, it seems like.
I think any consensus assumption, there's a Trump put, things are we're going to have this big unfreezing of activity. Every consensus assumption has been thrown out the window. I think Tom hit on something important, though, about American exceptionalism. In our weekly today, we had a couple charts buried in the back where we were able to look at European domiciled investors and what they're doing, and they're taking money out of the U.S. and putting it into Europe. In the U.S., it's kind of like more neutral-ish on the U.S., but the money is flowing into Europe. So I think that, regardless of whether we stabilize here in the U.S. and the U.S. can rebound, I think the door to Europe has been opened.
Lord Calvasina, thank you so much. Greatly appreciate it with RBC, and of course our honor of being with Barron's 100 Women in Finance, along with a very good group, including Ellen Zentner.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Mike Green starts a strong year with Simplify Asset Management, more of a bigger, broader view with his hedge fund experience as well. I want to get to the hedge funds in a minute, but when you came in, you got in through the rain. You said, the money's moving back to Europe. What does the quote-unquote money moving back to Europe do to the Dow Jones Industrial Average?
Well, it really depends on where it was invested. But one of the things that we have clearly seen is the European and rest of world investment into the United States, primarily to access the Mag 7. But honestly, increasingly through things like passive total market allocations, has been invested in the United States. Now that Europe has to bring that money home, we actually are starting to see the first signs of what we have always talked about as financial repression, which is directed return of assets. You've seen pension plans in the UK encouraged to bring more assets home. You're seeing headlines of French banks buying into strategic wastewater and treatment in their own country. This is causing the dollar to sell off as that money comes back and is converted to euros. And it's also causing U.S. assets to sell off. And I think that was an unintended byproduct.
So there's a link directly into the stock market in America.
So, Mike, I guess a lot of investors are trying to say, all right, this pullback in the market, is it a healthy pullback in an otherwise constructive market? Or is it something else reflecting a new world where tariffs are the name of the game, which calls into question growth and inflation and so on?
Well, I was going to joke that if April showers bring May flowers, what do March showers bring? And the answer is terrifidils. Right?
Okay.
So what we are absolutely seeing, I would say, is not healthy, although it is necessary. Right? So when we talk about Europe needing to reinvest in itself, when we talk about the rest of the world having to take on the burden from the United States for defense on a global basis, or at least on a regional basis, they need those funds to reinvest. Now, is this healthy, quote unquote? Does it mean it reflect good economic outcomes? No, we know that's bad, but it is unfortunately necessary. It's probably something we should expect to see more of going forward as compared to less.
Torsten Slok Apollo was out with a note over the weekend saying basically the consumer's really, really slowing down here. He quoted a bunch of statistics, including last week the airlines took down their earnings. Kohl's, a big retailer, took down its guidance. How do you feel about the consumer here and what it means for this economy?
Well, I think what we're seeing, unfortunately, is the air coming out of the Trump enthusiasm trade.
Yeah.
So we saw a huge bounce in the fourth quarter as it became apparent that Biden had withdrawn from the race, that the pivot to Kamala Harris had not worked for the Democrats. In turn, that led to a surge in consumer confidence. Unfortunately, underneath that, there was just always tremendous weakness. This bifurcated economy had been something we've seen for a long time. There's been continual deterioration in consumer credit metrics. And now, of course, we've got the reporting that's coming back on, whether it's student loans, or we're starting to see the disconcerting information coming out of the FHA on subprime mortgage crisis that has been created there. All of this is basically just reversing that sentiment bounce and exposing what was already happening under the surface.
So what do we do here? Do we get defensive? Do we buy the dip? How are you talking to your clients these days?
Well, the biggest thing I would highlight, one, we mentioned the idea of the real rate, the 10-year real rate. That seems very much at odds with almost everything else we're seeing. When there's uncertainty around investment, you should look for certainty. Or when you can find that opportunity, that 2% real is a relatively attractive yield versus history. So that's one thing I'm encouraging people to make sure that they take a look at. The second component is to recognize that the markets are just like they were going into COVID. We know there's something ugly out there. We know there's problems out there. But they can't react until the flows from 401ks, et cetera, start to deteriorate, until that non-discretionary fund starts to change.
Bloomberg surveillance nationwide on your commute this morning. We welcome all of you. Good morning, 99.1 FM, Nathan Hager's Washington. Good morning to 92.9 FM in Boston. Saw some Red Sox baseball this weekend. Destined. I think they can be first place by April 15th.
Oh, nice.
Don't ask me about April 16th.
Big call there.
As well. We say good morning, Bloomberg 1130 in New York. Wherever you are in the weather-torn America, be careful out there. And today, Michael Barr will have some good updates for you. Mike Green with us to Simplify Asset Management. What is Simplify?
Simplify is an ETF firm. We were launched in September of 2020 in response to regulatory change that facilitated the inclusion of alternative strategies in ETFs.
Hedge funds within an ETF structure.
Yeah, there was a big change in regulation. It's going reasonably well. We've got several funds that are doing quite well. In particular, managed futures has been an area for us that's been really successful. Some of the revisions or more conservative ways of tapping into volatility markets have been successful for us. We've grown from about 200 million to now about 7 billion.
How does long short do here, away from Simplify? Just as a general statement, to me, it's stochastic on both sides. I'm catching a knife on both sides on a daily basis.
So actually, this is one of the areas I spend a lot of time talking about passive. I tend to play a bit of a psychologist role for short sellers because the problem is they are short securities that are convex in their structure, right? And so the Vanguards, et cetera, those passive flows, when those come in, they're larger than any one player. And as a result, people are getting shaken out. And a big chunk of the volatility that we've experienced has been a breakdown in correlations, a breakdown in rotation and leadership as that Mag 7 turned around and went down. That caused unwinds and significant stress in the long-short community that's manifested itself in that wild gyrations that we've seen.
So where are you seeing funds flows today? Maybe over the last couple of months, actually.
Well, it really depends on the underlying fund, right? So managed futures, as I mentioned, is an area that's one where we're seeing a lot of interest as people are unsure about the protection that's provided by bonds in this environment. So they're looking for alternative non-equity correlated assets. That's been an area that's attracted some funds. We're starting to see money flow into commodities again. Fears about inflation are kicking in. And obviously things like gold are attracting a ton of assets, not just domestically, but also internationally.
Is gold and commodities in general on a trend basis? You mentioned managed futures, but CTA 101 is commodities trend.
Yeah.
Is gold trending?
Well, gold is clearly trending. We are certainly seeing elements of that. Other commodities, particularly the softs, are starting to show some indication of trend as well. And so that's been an area that started to attract some capital.
So what do we do here? I mean, as it relates to kind of risk on, risk off here, I kind of feel like we're at a kind of a fork in the road a little bit here. I'm not sure people really want to jump in and say, I'm buying this dip here. How do you guys think about it?
Well, we watch it on two fronts. So one is the systematic flow. So we mentioned CTAs. CTAs have increasingly...
is?
The trend following type strategies. So the trend
following.
has
Okay.
broken down in the S&P
Ready?
500.
Monroe Trout. Good morning.
Perfect.
I was weaned on all these animals. One of them, by the way, folks, is a guy named Jay Henry from Boston. I think he has a baseball team.
He has a baseball team that is always in first place at the start of the season.
Always in first place. We'll get. See, let's digress here. Let's do it. Paul, that was great. Let's do an audible here because Mike Green and I just take it for granted. There's stochastic trend, and I'm going to say 35 years ago, Paul Raybar, Monroe Trout, a bunch of other animals figured out this is MIT.
Yep.
Who do we talk to up at MIT?
Oh, yes. The young lady's very smart, super smart.
And this is Andrew Lowe up at MIT. Explain CTAs and how they are better at not losing money.
Well, that's a very dangerous and loaded statement. But what I would emphasize on any trend following is it's very much like an option theory, right? If you buy a call option, as the underlying moves into your strike price, the delta picks up on that, meaning that you are gaining exposure. Trend following just does the exact same thing. It increases exposure as the trend increases, but it doesn't pay the volatility premium. That's the really key component. You effectively flip the narrative around. You play the dealer who is delta hedging as compared to the buyer of the option who's always starting behind basically, a 3-ball, 2-strike setup.
Katie Kaminsky's saying,
yes,
that was very good, Mike Green. Nailed that.
Katie is fantastic.
Well. Is there a trend in place right now?
Well, there had
in the equity markets.
In the equity markets, there had been a trend, and so part of what we've actually seen is we've removed that element of trend. The CTAs have been flowing out again. That's another source of these flows of funds, which is increasingly the feature that we'd emphasize. So, what I was highlighting earlier about what Europe's doing, it's what I would call portfolio effects or portfolio rebalancing effects. When people choose to make changes to their allocations, we see those flows. That impacts currencies, it impacts equities, it impacts bond markets.
International investors, we had heard towards year-end last year, maybe even into the first quarter a little bit, money really coming in from Europe into the U.S. equity markets because where else are you going to go? And has that changed?
Well, that has changed, right? So that's component of flow has shifted. And again, that's part of what I would emphasize. When you have discretionary flows, they create these kind of waves or disturbances, but it's the structural flows that really matter. And so historically, we've seen a growing fraction of allocated portfolios sending money from Europe. If that changes on a structural basis, this is a really big change in the American exceptionalism story.
We clearly haven't seen catharsis yet, in no way, shape, or form. But with a VIX of 22, we're sort of middling right now.
Well, we are, we really are middling. One of the things I'd emphasize, though, is that the VIX used to be used for hedging. Prior to the advent of zero data expiry options and the shorter time component, we would have to use that 30-day point for hedging. Today, not so much. We're seeing that VIX be relevant, I would argue, is heading into this option expiry, which is just in a couple of days. Obviously, on Friday, we see option expiry. That is actually creating a condition under which a lot of funds that had created income streams where they'd sold put spreads or they'd sold calls, they're somewhat trapped in that positioning. We're going to get a reset with this option reset. I think that could provide some relief against some of these flows.
A question you're thinking about, but maybe away from your remit, with the Fed on Wednesday, is the geopolitics and what we're seeing at the White House so overtaken the dialogue, the narrative, that the Fed doesn't matter?
Well, the Fed always matters. Powell could surprise. I think we would all be somewhat surprised by anything meaningful coming from the Fed, given the uncertainty around inflation and candidly given the uncertainty around the development of the economy. Those consumer sentiment components that we indicated are deteriorating at an alarming rate, and I agree with that. It hasn't yet translated into final sales, and it hasn't translated into unemployment claims. And the Fed, although I think unemployment claims are incredibly misleading, the Fed is very focused on that metric.
Mike Green, thank you so much. Great way to start the. We can do this every Monday, rain or shine.
Yeah, exactly.
Mike Green, thank you so much. Simplify asset management.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Julia Coronado joins, founder, president, Macro Policy Perspective. She's got a green plant behind her. Thank you, Julia, for that. And this is important, folks. This is the interview of the day because nobody's paying attention to the Fed. So we're going to dive into this with Dr. Coronado. We're going to slow down and spend some time on this. Julia, how does the Fed synthesize the data in this moment? Do they just step back and say, we give up?
Well, I don't think they're going to give up, Tom. The Fed never gives up. You know that. I think what they do, though, is they do step back and they say, look, there are competing influences. There's a lot going on the policy front. We just don't know. Powell, in his last speech, stressed the net impact of all of these policies on the economy. They go different directions. And so the Fed is really going to have to wait and see because, look, the inflation data haven't made the progress the Fed had wanted. We're still hovering above their target. The labor market, latest data, still resilient, so they can afford to wait and see.
The money question right now, and I'm going to go back to Frank Knight at Chicago and Knight and Uncertainty, and the idea of ambiguity. If they cut interest rates, does that boost growth? Does it boost nominal GDP activity? Or are we beyond that now where we really don't know the outcome of a rate cut?
It's a great point, Tom. The rate cut isn't going to be the antidote to all the worries that investors and businesses have right now. There is a tremendous number of sources of uncertainty right now. Trade policy is one of them. Immigration is another. Cuts in government contracts is another. Reshaping global alliances is another. So I think there's just many sources of uncertainty. They collide with each other. It's very difficult for businesses to make longer term plans. Of course, we all get up in the morning and go to work and run our businesses and do our jobs. But are you going to make the bigger decisions about hiring, about CapEx, about moving forward with strategic initiatives in this environment? It's difficult. It's challenging. So no, a rate cut isn't the antidote to the uncertainty that we face.
Julia, the uncertainty that you mentioned from whether it's tariff talk or just Doge and things like that, it's certainly calling into question growth forecasts, inflation forecasts, and we saw the University of Michigan data last week really capture that uncertainty in the marketplace.
Oh yes.
The Trump administration says, okay, that's some near-term pain for some long-term gain. Do you see the long-term gain, or how do you kind of think about that story?
It's difficult right now to see what the strategy is. What is we all knew that there was going to be a trade war. We believed that the focus was on unfair trading practices in China and that China would be the focal point, and then there would be other secondary initiatives. And now the focal point is our main trading partners of Canada and Mexico. And what's the end game? What's the strategy? I think that's what's harder to see. It's a little cheeky of Secretary Bessent to suggest that this is just near-term pain for long-term gain when markets are inherently supposed to be forward-looking, right? We're supposed to see through the trade-offs. And if we can see, okay, we're going to get this now, but we can see where we're going, then markets maybe wouldn't be so volatile or struggling to see the through line of all of this. I don't think it's clear. and it's chaotic, and so I think that's what's lacking.
Julia Coronado with us. We continue with Dr. Coronado here on this St. Patrick's Day. Across the nation on your commute, we say good morning, 99.1 FM in a very active Washington. On YouTube, subscribe to Bloomberg Podcast. We are humbled. Paul and I are absolutely humbled at how it's growing each and every day. Paul, futures deteriorate slightly, Dow negative 200, SPX negative 18, the VIX 22.25.
Absolutely, Tom. So, Julia, have you taken down, or do you expect to take down your GDP outlook for maybe this year or next year?
We started the year below consensus because our emphasis was that some of the policies that are going to be negative for growth are going to happen before the policies that are positive for growth. And that seems to be playing out. So we are at 1.4% for GDP this year. And that is something that we had kind of starting where we are around 2% and then slowing as the year unfolds, given specifically reduced immigration and trade wars. I think that, we just did a survey of market participants, which we do every quarter ahead of the Fed meetings. And investors are also taking down their median growth forecast, went from 2.2% for this year down to 1.5% for this year. And that's a very striking result. And we asked a lot of questions about the individual policies and the net effect of all of the policies. And on balance, they are expected to be growth negative for this year.
Have you marked down nominal GDP? Or is it such a stagflation that inflation stays up and supports the animal spirit?
We do have a little bit of the stagflation flavor, at least for this year. We kind of see this as macroeconomists unfolding with a shock to prices from tariffs. And that in and of itself is demand destroying, and that may lead to lower inflation in 2026. But what you get in the near term is a burst of inflation that keeps the Fed from stepping in as early or as aggressively as they typically would.
I'm absolutely fascinated in this milieu of the effect of the Fed, and have they become impotent?
We said that before the pandemic, and then the Fed stepped in and proved us wrong. So I would never say that monetary policy is impotent. What I would say is that they are likely to face, at least in the near term, conflicting pressures on their dual mandates. We may see the labor market deteriorate, but we may see inflation drift higher. That combination is just going to keep them on the sidelines for longer unless and until either the Bessent rosy view of a better future plays out and they don't have to do anything, or the recession, fairies start to sprinkle their dust on the U.S. economy and the Fed ends up cutting rates more aggressively than is currently priced.
I mean, Paul, get a couple more questions in here, but the overwhelming thing to me is the labor data that's deteriorated. And the last 4 days?
I know.
I mean, I'm not making this up.
No.
They're hockey stick moves.
And we're going to see, Julia, we're going to see some retail sales data today. And I think people are a little bit nervous about that, given that you missed sentiment data from last week here. How do you think the consumer's doing right here?
Yeah, consumers, it's hard to count them out. We saw some softness in January. Some of that looked to be, when I look at the consumer data, I see some evidence that there was a pull forward of durable goods spending in Q4 ahead of the tariff. So we saw autos and electronic sales really surge in Q4. So we're kind of due for a little bit of a pothole just because that was a pull forward. But we are going to look at sort of the core or the control retail sales categories, the really discretionary areas like, restaurant spending or clothing spending. Are consumers being cautious in those areas? That's usually an early indicator that they're pulling back more broadly.
Julia, we got a central banker running Canada. Your comment on Mark Carney's ability to lead Canada forward.
Yeah, he's a intriguing choice, not a politician, a central banker, multiple times. Certainly, he has the chops. He knows policy. He's been a global leader, so he has all the relationships that are kind of needed at this moment. Canada has to restructure its trading relationships, its strategic relationships, given what the U.S. is doing. And Mark Carney's, I mean, I can't think of a better person to help lead that effort, which is so critical right now. So he's an unusual candidate, but somebody that, you know, he definitely has the policy depth.
Julia, your plants are very green. Dr. Coronado with macro policy.
I try.
Perspective. Thank you so much. Sweeney to the rescue. Why are retail sales on a Monday? That's un-American.
I know. I'm not sure. We'll see what happens here at 8:30. Yeah, exactly.
Like 15 minutes, folks. Mind freeze. I was worried about my bracket instead of retail sales.
Eco go.
I have duped further. I haven't got to Final Four. You know, I don't know if you know this, folks. I got like an 800-page agreement. It's like codified. And page 472 says I have to put Purdue. To Final Four. It's in
engineering students.
The bracket.
Yep, absolutely.
So I lose every year on Purdue. Are they any good this year?
Not as good as they've been in the past couple of years, I don't think, but they're always good. Coming out of the Big Ten.
We're working at it as well. Julia Coronado, thank you so much. That was very informative.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Sometimes in the racket, you get lucky as well. I'm going to do a statement here of all the people helping us this morning. Bloomberg Surveillance this morning, we're brought to you by IBKR. Will U.S. natural gas production, will it exceed 3.27 billion cubic feet in January? At IBKR Forecast Trader, the yes was recently at 9%. Check the data. Spot the trends. Start predicting today at ibkr.com/forecast. Sometimes you get lucky. You have somebody in because there's lots going on in whatever they do. And then something over the weekend happens. Julie Norman established, besides her fandom of the Baltimore Orioles, she established the academic study of terrorism, and particularly with an angle to the Middle East. And to have her on here after what we see in Yemen is truly a pleasure. From the University College London, Professor Norman, this morning. When we go in with jets, multi-million-dollar jets, and attack the Houthis, Julie, describe the landscape of Yemen and wherever the Houthis are.
Yeah, well, good morning, Tom. I'm not sure I created the field of terrorism studies, but nice to be with you. So I would say these are not the first strikes on Yemen that the U.S. has been taking. There were numerous strikes that were undertaken under the Biden administration when these Houthi strikes on ships in the Red Sea started over a year ago. So this has been ongoing. Yemen is a country that the government is divided. The Houthis control the capital of Sana'a and some of the northern areas. This is where most of the strikes took place. But again, I would say this is something that is happening in a wider regional moment as well. A lot of this is Trump trying to put pressure on Iran. I think this is really where these strikes over the weekend are coming from. And we can kind of expect some escalation from what we saw over the weekend.
Is it like ISIS where we're going after leaders?
I would say it's a little bit different than ISIS. I mean, first, this group is just very different. They're a rebel movement. They emerged about 10 years ago. They, again, control different parts of the country. And when we're going after them now, it's mainly this, not for what they're doing internally, so much as their strikes on global shipping in the Red Sea, as well as U.S. military assets there as well. Some of the strikes are targeting military infrastructure, the abilities from the Houthis themselves. But over the weekend, they did start targeting leadership. And by targeting leadership, that also means you're often targeting residential areas. So we did see a much higher casualty rate over the weekend, estimates over 50, possibly as high as 100.
Julie, what do we know about the Trump administration's policy towards Iran? How do you think they're going to approach it?
Yeah, well, I mean, we've obviously heard the maximum pressure speak for a while, and I think we're starting to see what that looks like. We've already seen much harder sanctions going on for Iran, which was expected. But moreover, we saw this letter sent by Trump to Iran last week, essentially saying, you need to negotiate and essentially give up the nuclear program or be prepared for military action to take it out. And we assume that would be, through U.S. and possibly with Israel as well, which has been threatened in the past. So this, I think, is ratcheting up now. And I think these strikes on the Houthis were part of the Trump administration's calculations for that. With that said, for me, the Houthis operate with a bit more autonomy from Iran than I think the administration is recognizing here, and I'm not sure how much Iran could rein them in, even if they wanted to.
Do they have defenses? I'm trying to frame out. I get the landscape. My amateur take is it's a lot of desert, a lot of poverty. I don't want to be simplistic about it, but like when our jets go in, Paul, do they have anti-aircraft? I mean, is there risks here, Professor Norman?
So I would say there is some. I would say what the Houthis do best is they use a lot of drones. They use a lot of strikes of their own externally. They don't have a super sophisticated, missile defense system or something like that I think would put us at direct risk from some of these things, but they will retaliate, again, mostly where they can do it best, again, on that shipping that's coming through the waterways where they essentially have a straight shot there. But in terms of overall military capacity, this is obviously something where there's a reason why the U.S. has so many assets in the region is to try and push back at groups like this. But even with limited sophistication, they can still be incredibly disruptive.
Julie, tomorrow there's a scheduled call between President Trump and Mr. Putin. What do you expect to hear from that call?
Well, I would say I think we're all waiting to hear what is said. I mean, obviously, there's this discussion now of a 30-day ceasefire. Ukraine has agreed to it. Putin has not said no, but has certainly said there are going to be major conditions and things he wants to discuss. We heard from Trump's envoy over the weekend that they're moving closer to some kinds of agreement. But I think what's really going to be on the table is what does Putin actually want and how willing is Trump to essentially give it to him in order to get to some kind of, right, ceasefire, pause, truce, what have you.
Why should Putin agree with Trump? I don't get it.
Yeah, I mean, I would say I'm not sure that he will, and I think there's probably more of a gap between them than Trump
Right.
maybe wants to realize right now. I mean, right now there is again this idea of re-engagement with the U.S., of reopening diplomatic channels, of easing some of the tensions that have obviously been in place for the last 4 years, and there's a lot of incentive for Russia to want that to happen.
Okay, Julie, we really don't care. I mean, the reason you're on is I'm filling out my bracket. I'm fed up with Paul Sweeney, Duke. I mean, I do have Duke, Alabama.
You do?
In the East as well.
Okay.
Julie, do you fill out a bracket at the University of College London?
Oh yeah, I mean, I went to Duke, Tom, so
Yes.
I'm all ready for brackets, and so Duke goes all the way for me every year, even when they're not having a good year. But I'm definitely going #1 for Duke right now, and I'm super excited about the tournament. So I think you should listen to Paul these days.
There we go. Hey, Julie, we're 2 months, a little bit more than 2 months into the President Trump administration here, and it seems to be from a foreign policy perspective a little bit of a kind of a go it alone type of thing, kind of disengaging to various degrees from our allies. As you sit back and look at this, how do you frame it out?
Yeah, well, Paul, I would say here over in London, people definitely aren't sitting back. They're sitting up, very rapt attention at how the U.S. is changing very quickly. There's a real worry right now, not only for the U.S., changing on some policy things, but really being, potentially an unreliable actor, an unreliable ally, and in some ways even adversarial in many spheres. And I think the world is watching very closely to see, is this just a short-term run? Is this bluster, or is this a real change in how we do things?
What is the change, Professor Norman, of Trump foreign policy / military policy, first term and second term? What's the distinction there?
Yeah, so I would say first term, Trump overall was more isolationist, and we heard that language obviously in the campaign for the second term also. But with the second term, if anything, we've seen more of an interventionist foreign policy, not so much with military force, though I would say one reason that the attacks over the weekend stood out is it does indicate that the administration can and will use military force, but really much more of an expansion, Panama, Greenland, Gaza, these areas that were not really talked about as focus areas, but the U.S. obviously has interest there, and Trump is going to push for them.
Julie Norman, thank you so much. Next time you're on, we'll frame out Orioles baseball as only you can do. Professor at the University College of London.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Right to the newspapers. Cy, right? We're right to the newspapers this morning. Thank you. I'm Randall here. For those of you on YouTube, somebody came and said, "How do you tie a bow tie?" We're not going to waste time now.
Oh,
Lisa's time is too. But in the next block, I'll do the quick bow tie thing like I did on LinkedIn years ago. What a weekend for the newspapers. They were on fire.
Yeah, there was a lot going on. All right, so this one I want to start with because this is from Bloomberg Screen Time. Lucas Shaw put out this great article about the next CEO of Disney.
Must read.
Yeah, they say it's in full swing. So they're saying that there are two leading candidates. We go to entertainment co-chair Dana Walden. She was at this Morgan Stanley conference talking about the profitability of Disney streaming services. And they said what that shows is that her chance to show the ability to handle that Wall Street side of being a CEO. Okay. And then you have Parks chief Josh D'Amaro. He spoke at another event about his creative ideas. But what that showed is that how a Parks guy can handle TV and film. So it's showing different sides. He talked about video games too, which is apparently a possible growth area
for
Disney.
But the previous guy that got fired, he was a Parks guy.
He was a Parks guy. That's right. But I mean, Parks are now the biggest profit contributor to the entire company. So you have to give the Parks guy a certain
Come on. The Parks guy's going to sit in a meeting with the three representatives for The Rock.
Right, exactly.
And go back and forth.
Exactly.
I'm asking.
I don't know. I mean, again, this is the third or fourth bite at the apple for Bob Iger in succession. He's blown it every time.
This is tough talk, but I mean, in the world of executives, this is like how not to do it. Right?
How not, and it's funny because it was at a time he had it perfectly set up, and then he chose not to leave 10 years ago. Anyway, there we go.
Oh my gosh.
Sweeney's in a rare mood. Did you start on St. Patrick's Day yesterday?
Exactly, yes.
Is there Guinness in your it's not Tang in his cup this morning.
Exactly.
Is it? All right, moving on. President Trump's tariff policies and federal government cuts, we've been talking about it, right? But the New York Times has this article saying that it's boosting stocks overseas. So they point out investors pulling money from the U.S., relocating it around the world. So they give examples, right? They say since Trump's inauguration, S&P 500 fallen 6%. Hang Seng risen more than 20%. DAX in Germany increased 10%. They go to Europe Stock 600 gaining more than 4%. So it has all this data, and it shows how over the past week, investors pulling money from funds that buy U.S. stocks for the first time this year. So kind of the money shifting to overseas. Wow. That's what they're saying that the trend is right now.
Yeah, because we heard from a lot of fund managers late last year, Europeans are flooding into the U.S. market because that's where the performance was with all the technology.
I don't know what to make of it. I think what Mike Green said, Midland, somebody wants a vector for me this morning on the stock market, they're not going to get it.
Yeah, who knows?
I don't have any value add here at all. Lisa Mateo has a value add. Next.
Thank you. And not sure if you've noticed this one, Tom, but there apparently a lot more kids are using AI to get better grades in school, and they're not telling mom and dad about it. They're just kind of touting it that they're doing good, in school.
What do you think?
So I don't know. I think if you use it as like this launch pad to kind of, if you're stuck and you have like, brain fog, you can't think of where to start an essay. Like it's a good way to spark, some good ideas, but you can't just copy and paste and like put it.
I have no idea how teachers police this.
Well, that's the problem. The teachers are saying they can't, and there's even dozens of companies that they have apps that claim that they can write essays, complete homework with software that cannot be detected. So they're there's these companies coming out doing this too. So I don't know. They're just saying with kids, it's hurting the way they learn.
I am so glad
they
I'm done
can't
with this.
think.
Well, it's like devices with the kids. I mean, whether it's lecturing them on the value add back then was a Seagram's and 7.
Yep.
But can I just say that I think you look at all the Cliff Notes.
Yes.
There's only 6 I didn't buy.
Yellow and black cover. Yeah.
Oh my goodness.
Who am I to tell them? I mean, I got through aerospace engineering liberal arts on Cliff Notes.
Yeah.
Plato? How about Plato?
Oh my goodness.
But the Cliff Notes didn't write it for you.
You're right.
They're
You're right.
writing
You're
whole
right.
Lisa
essays.
Mateo, the newspapers. Thank you.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.